Hi there, welcome to another Equity Trust Explainer video. My name is John Bowens, and in this session, we're going to talk about the required minimum distribution, RMD for short. We'll also talk to you specifically with reference to RMDs as it relates to holding illiquid alternative investments in your self-directed IRA or other tax-deferred savings account, such as real estate, private equity, private direct investments, cryptocurrency, gold and silver, and much more. We'll show you how to calculate the required minimum distribution, what age you have to start taking required minimum distributions, and what type of accounts you have to consider. So first, let's start with what is a required minimum distribution. This is the tax code stating that on an annual basis, once we turn a certain age, we have to begin distributing money from our tax-deferred savings accounts. And we're going to talk more specifically in a moment about which plans we have to take required minimum distributions from versus the ones that we don't. So every year, starting at 72, we have to start taking money out. Now, don't be confused by the age of 70 and a half. See, in January of 2020, January 1 of 2020, the law changed. Prior to January 1 of 2020, the required minimum distribution age was 70 and a half. January 1 of 2020, the law changed, and that age is now 72 years of age at the time of publishing this video. Now, that number could potentially change in the future, and life expectancy tables published by the IRS could potentially change in the future. So certainly we'd encourage you to team up with your CPA or other financial professional as you navigate these waters. But this video should give you the guidance that you need to get started in understanding what a required minimum distribution is. On behalf of Equity Trust, we always encourage folks to seek out their licensed professionals, as we are one member of your financial team and we don't provide tax, legal, or financial advice. So let's jump into what type of plans would you have to take a required minimum distribution from. So the first plan that you'll need to be aware of is a traditional IRA. In some instances, this might be displayed on your statement, your financial statement, as a rollover IRA. This would mean that you had a 401k and you rolled that over into, and it was tax deferred, of course, and you rolled it over into what's known as a rollover IRA. Still tax deferred account, synonymous with a traditional IRA. Maybe you have a SEP IRA, Simplified Employee Pension Plan, which is also tax deferred, would have a required minimum distribution. Maybe a simple IRA, which is another employer sponsored plan. Maybe it's a 401k, maybe a 403b, 457. Maybe you work for the federal government. Instead of having a 401k, you would have a thrift savings plan, or possibly what's known as a FERS plan. And so these are all employer sponsored or individual retirement arrangements that are tax deferred. Tax deferred meaning when you put money into the plan, you got a tax deduction, it grows tax deferred. And then when you take the money out after 59 and a half, you have to pay ordinary income taxes based on your ordinary income tax rate. Remember, if you take money out prior to 59 and a half, there's a 10% premature withdrawal penalty. You don't have to start taking money out at 59 and a half. That's a common question I get. You don't have to start taking money out again until 72 years of age. So those are tax deferred accounts. Now, what accounts don't require a required minimum distribution? So here we have our tax-free accounts. The first account is the Roth IRA. So you have your Roth IRA, which is funded with after-tax dollars. You also hear this referred to as post-tax contributions. So Roth IRA is funded with after-tax dollars. It grows tax-free. And then when you start taking money out after the age of 59 and a half, assuming that it's also seasoned for 5 years, you pay 0% tax on your withdrawals. And you don't have to worry about required minimum distributions. You may also have a Roth 401k, or you may hear this referred to as the Roth component of a 401k. Now, some Roth 401ks will actually have a required minimum distribution. It's going to depend on your ownership interest in the business that's sponsoring the 401k. We have more details on that for you. But generally speaking, what folks will do once they get close to the age of 72 is they will roll over their Roth 401k into a Roth IRA in order to avoid that required minimum distribution. Again, RMDs are going to start at 72 years of age. So these are the types of plans that require required minimum distributions, tax-deferred accounts. You'll have required minimum distributions, and then your tax-free Roth accounts will not have a required minimum distribution. We could then get into inherited IRAs in more detail. We have separate training for that. But just to give you a quick overview on inherited IRAs, the law changed January 1 of 2020, not only for required minimum distributions, but also for inherited IRAs, non-spousal inherited IRAs. What happened was the law changed to where if you inherit an IRA starting January 1, 2020 onwards, and it's from a non-spouse, so it's a non-spouse inheritance, then you have no required minimum distributions, whether it's in a tax-deferred account or a tax-free Roth. However, you have to take all the money out within 10 years. Now, there are a few exceptions to that rule for individuals under the age of 18. That 10-year rule is a little bit different. But by and large, if you inherit an IRA from a non-spouse, you're going to have to withdraw all the money within a 10-year period. Now, again, good news is you do not have to take a required minimum distribution any longer from an inherited IRA that you inherit post January 1 of 2020. Again, we have additional training on that. All right, so now that you understand that, let's jump to the IRS, irs.gov, and to look at the life expectancy table so you can understand how to calculate this. And we're going to put up on the whiteboard a case study, an example, if you will, of a required minimum distribution and how to calculate this. So if you want to find information on this and you want to find the life expectancy table that's going to apply to your specific situation, you can go to the IRS website, irs.gov, and you'll see here there's a publication called Publication 590B. So let's go ahead and open up Publication 590B. And you'll see in 590B, it's labeled Distributions from Individual Retirement Arrangements. And then we're going to go down here to our required minimum distribution, which is on page 7. So we go down to our required minimum distribution, and you'll see here that there you have the age of 72, which is when you have to start taking required minimum distributions. And if we scroll through this here, you'll see it says figuring the owner's required minimum distribution. So we're going to go ahead and click on that link, and that's going to take us up here. So you see distributions during your lifetime. So we're going to focus just on when you turn 72 years of age, if you have, whether it's stocks, bonds, and mutual funds, or real estate, or cryptocurrency, or precious metals, or whatever it is that you have in your account, how do you determine what that calculation is going to look like? So distributions during your lifetime, required minimum distribution during your lifetime are based on a distribution period that is generally determined using Table 3, Uniform Lifetime in Appendix B. However, if the sole beneficiary of your IRA is your spouse, who is more than 10 years younger than you, then you have to look at a different life expectancy table. So for all intents and purposes, most people are going to be under this uniform lifetime table. So we're going to use that for our example. But know that if you're under different circumstances, you'll just want to follow this document and find the applicable life expectancy table. So let's go ahead and click here into the uniform lifetime table. This is Table 3. And you'll see at the age of 72. So we're starting at the age of 72 because, again, that's when we have required minimum distributions. And you'll see that the divisor or the distribution period is 27.4. So what does this actually mean? What this means is at 72 years of age, the actuarial analysts are predicting that you have 27.4 years to live. When you're at 73 years, you have 26.5, 74, 25.5, so on and so forth. This number here is your divisor. So we're going to take all of our tax-deferred accounts, and then we're going to divide by this divisor. I'm going to show you that in just a moment. Now, let's go all the way to when you get up there in age. Let's say you're 96. The divisor is 8.4. So we're going to take the total amount, and we're going to divide it by 8.4. Mathematically, and you'll see this when we put it on the whiteboard, mathematically, as you get older, you have to take a larger percentage of your total principal balance. It's important to understand that at 72, it's not as if you have to take 30, 40, 50, 60% of your principal balance. A lot of people are worried about holding alternative investments in their self-directed IRAs, tax-deferred accounts, because they're worried about the requirement of distribution. And certainly it should be a concern. What you want to make sure of is that you have enough cash flow or you have enough liquid assets elsewhere to satisfy your required minimum distribution on an annual basis. And what you're going to learn is that it's not 30, 60, 70%. In fact, in your first year, you're going to find it's only about 4% of your principal balance. So that being said, let me stop sharing the screen there and let's go to an example. So we're going to call him William. This is a hypothetical example. William, I like to use that name because of William Roth, who was the legislative sponsor of the Roth IRA. Going back here very quickly, back to our tax-deferred and tax-free accounts, it is important for you to understand that if you have a tax-deferred account, you can actually convert a portion or all of that money into a Roth IRA. Now you have to pay taxes. This is what's known as a Roth conversion. It's going to be based on your ordinary income, and the amount that you convert, you have to add to your tax basis. But if you convert money to your Roth IRA, get the taxes out of the way now, you would have no required minimum distribution going forward. So for those of you that are younger than 72, you might consider, if you don't want to have to worry about this required minimum distribution and you maybe want to leave a legacy to your children or grandchildren, if financially it makes sense to you, you could actually look at converting a portion or all of your money into the Roth IRA to either mitigate your required minimum distributions or completely wipe them out altogether, rendering you having no tax-deferred savings and all tax-free savings. Okay, so back to our example. That's just some context behind why I like to use William. That's for William Roth. So in a traditional IRA, let's say William has $300,000 in value. And let's say that that value is broken up between some real estate, maybe a private equity investment, maybe some gold and silver, maybe even some cryptocurrency. So let's refer to these asset holdings as maybe illiquid. Now, illiquid really depends on your situation. For some people, they might be able to sell a property within 30 days, or they might be able to cash out of their private equity investment or redeem within a short period of time, or gold and silver or cryptocurrency. But generally speaking, there are investors that look at these investments as illiquid. So let's assume that we are considering these more illiquid investments and we have $300,000 in total value. Now, we're probably going to have some cash as well here. So let's say we have a pool of cash over here in the amount of $30,000. Or maybe that's in publicly traded money market accounts. So low interest bearing, but very low risk, and we can easily liquidate those assets. All right, so that's what we have in traditional IRA number one. And let's assume that this is in William's equity trust IRA. All right, this is in his self-directed equity trust IRA. And then we have William, he has, let's just say it's a traditional IRA with a regular brokerage, right? A brokerage that's only going to let someone invest in stocks, bonds, and mutual funds. So I'm just going to say, I'm not going to use any individual names, just going to say XYZ broker. We have a traditional IRA, and let's say we have $200,000 in this account, and that's made up of, let's assume, publicly traded stocks, maybe mutual funds, ETFs, bond funds, maybe a combination of equities and fixed income securities. So these are securities that one could argue you could quickly sell these securities. William could quickly put a trade request in with his advisor or do it on his own if it's self-directed and get himself into cash quickly. All right, and then William has a Roth IRA, and let's say he has $100,000 in his Roth IRA, and let's say that he has a property in there, he has some cash, and let's say maybe he has a private money loan that he made to an investor worth $10,000. Right, just using some examples here. And so now what we do is we need to calculate our required minimum distribution. Now, good news is, remember, Roth IRAs have no required minimum distributions. So we don't have to worry about, in our calculation, this Roth IRA. That's totally tax-free. providing that William waits till he's 59 and a half or older and the account season for 5 years, he's got no tax liability there. What we have to do is we have to combine both traditional IRAs here for our calculation. So we're going to take our 300,000 in this IRA plus our 200,000 in this IRA, which is going to get us 500,000. So this is going to be our numerator. And then we have to look at what our denominator is. So let's go back to our IRS life expectancy table. Again, this is for someone whose spouse is not more than 10 years younger. And we look at 72 and our divisor is 27.4. Okay, so our numerator is our total portfolio balance. Our denominator is going to be 27.4. Okay, so let's go ahead and perform that calculation. And while we're doing that, remember, we combined both of these accounts together. And that's going to be very important. I'm going to explain why I am doing that, and I'm not calculating them separately. All right, could I calculate them separately? Of course I could. The math is going to work out the same, but I'm calculating them together for a very specific reason. So 500,000 divided by 27.4 is going to give me $18,248.18. I'm going to round up there. So $18,248.18. Now, if we look at that on a percentage basis, that's going to be 3.6%. 3.6%. So only 3.6% of the principal balance we have to distribute to satisfy our required minimum distribution. So we have 30,000 in cash over here. So we should be good for our required minimum distribution. We could take our full RMD from this account. Or maybe we don't have this 30,000 in cash. We can't take a required minimum distribution from the traditional IRA, but we can satisfy our entire required minimum distribution, combining both accounts, all from this IRA. So in other words, if you have an equity trust self-directed IRA and you have no cash in there, all you have is illiquid alternative assets, but you have a traditional IRA or tax-deferred IRA elsewhere, then you could simply take your required minimum distribution from that other account. Now remember, it's only 3.6% starting at that first year. Let's take a look at when you get a little bit older. Let's go to the age of 90. So you turn 90, and what is our divisor there? Our divisor at the age of 90 is 12.2. So let's go ahead and put 12.2 in our denominator, and let's run our calculation. So at the age of 90 years old, we have 500,000, let's assume, in our plan still, and we're going to divide by 12.2, which is going to give us $40,000, $40,980. I'm just going to round up, $984. So we have to take $40,984, and if we divide that by 500,000, that's going to be 8.2%, 8.2% of the principal balance. So demonstrating this for everyone, because if you sharpen the pencils and you're strategic about your investment planning and your portfolio management, even if you're holding illiquid assets into your later years of life, you shouldn't have to worry about the required minimum distribution. That being said, if you did get into a situation where you had no cash, you could actually distribute alternative investments. So for a property, you would deed that property to you. You take a distribution. If it's a private equity investment, you could distribute that private equity investment from the IRA, a portion of it or all of it, to satisfy your required minimum distribution. Obviously, you have gold and silver. You could take a distribution and have that physical gold or silver delivered to you or to wherever you want that delivered to. So those are required minimum distributions and how you would look at running a calculation. As I mentioned, I would encourage you to sharpen your pencil and maybe even team up with your CPA, accountant, or other financial professional as you navigate these waters, as you manage your portfolio or have someone else managing your portfolio, to make sure that you're putting yourself in the most optimal tax situation. And don't forget that with the Roth IRA, you don't have a required minimum distribution. You can convert money from your traditional to your Roth, and therefore you wouldn't have to worry about the required minimum distribution on the Roth IRA. One note to make mention of is if you're 72 and you have a traditional IRA, you have to take a required minimum distribution. So you can't just convert all your money into a Roth in order to avoid that RMD in that year. So you want to make sure you look at doing that before the age of 72 if that's what your plan is to do. I hope you enjoyed this training video on required minimum distributions, both for public securities as well as private securities. Until the next training video, keep leveraging compounding interest in the absence of taxation.